Thank you, thank you. Do you have that sign-in sheet? Thank you.
So again, yeah, I'm Anthony, this is Corey, we're with First Equity Funding. We're based out of Monmouth County, up near Belmar and Manasquan area, so not too far away. First Equity's been in the mortgage space since the early 2000s, and we've been in the hard money space ever really since the wake of the crash, and as flipping became more popular, we started doing more hard money in addition to the conventional stuff. So, just curious, how many people here are actively working with investors or want to work more with investors? Most people in the room. You know, I'm trying to, usually when we do these presentations, we're speaking directly to borrowers, and I sing the praises of hard money and how it helps you grow your business. But for you guys, really, it's important to understand how this is going to help you close more deals. You know, if you have a good investor client who's using cash, it's not too long before eventually, you know, all your money's tied up in 1, 2, or 3 deals. I can tell you most of our most successful borrowers are guys who are using hard money even though they have quite a bit of cash in the bank. The reason is it keeps them liquid. As good deals come across their desk, they can take advantage of it. We can work with them pretty quickly and get them funded. And so we've used hard money to help guys do, you know, 2 and 3 deals a month instead of 2 and 3 deals a year. So, you know, that's just some of what we'll get into. But so this is actually a little bit outdated. We actually increased our leverage since we put this PowerPoint together. The way we generally structure loans is for an experienced investor, we'll lend up to 90% of the purchase price. The 80% you see on the slides would be really for a newer investor. So generally speaking, 80 to 90% of the purchase price, and in all cases, we'll finance 100% of construction costs. Now, it goes without saying, but if you were to walk into Bank of America or Wells Fargo and ask for a loan to do a fix and flip, they would laugh you out of the place. So if you don't have cash, this is really a good option to get your deals financed. So there's two numbers that you got to be cognizant of. It's the upfront leverage, which is that 80 to 90%, and then there's the total leverage. So we'll do 80 to 90% of the purchase price and 100% of construction costs, so long as that total loan amount, we typically want it to be 65% or less of the after repaired value. So basically, you can do it backwards, and you can figure, if we're going to loan you $150,000, you divide it by 65%, that number is going to be $230, $250, whatever it is. That's going to be what we need the house to appraise for us to do the loan. If it doesn't hit that mark, it's probably a pretty tight deal. It might not be a good deal for the investor anyway. You know, so I have a lot of borrowers who, and Corey, you could probably agree, you know, it'll come in at a 75, 77 ARV, or loan to value to the ARV, meaning we're lending them 77% of the after repaired value. There's not a lot of, you know, margin there. There's not a lot of meat on the bone, so to speak. So we try to avoid getting into situations where we don't think the investor is going to make money. So we're a little bit more conservative in that respect, but that's why we don't really have any loans in default. We only lend to properties that, or lend on deals that make a lot of sense. So we'll just run through some quick numbers. So let's just say this was a newer investor, right? We would do 80% in this case as opposed to 90%. For us, we classify experience as 3 deals or more in the past 3 years. So once you're at that level, we'll bump that up to 85 or even 90%. But for our purposes here, we'll just say we're going to give you 80% of your $150,000 purchase price. You're going to put $50,000 in construction costs in. So we'll give you the 120 plus the 50. So again, total loan amount 170. So if you divide 170 by 65%, assuming the math is correct, I didn't put the slides together, so don't hold me accountable if it's not. 170 divided by 65 should come out to 262. So essentially what we're looking for on that loan is for that property's got to appraise for $262,000. So if you have any familiarity with hard money, you probably get some of that stuff. And that's really more for your borrower, but as far as why it's going to help you guys is because this is going to allow them to do more deals, and we'll get into it. But yeah, just a couple definitions here, and we'll circulate this PowerPoint to all you guys so you have this. But let's get into this. Okay, so the loans themselves, we do a 1-year term. He was just mentioning none of his projects ever go over 6 months. Really, you should probably be completing your projects somewhere in 6 to 8 months. If your borrower, or if your client is going into 10, 11, 12 months, probably means something went wrong. They had some permitting issues or something didn't work out. But 6 to 8 months is probably about average. So we give you a 1-year term, and there's no prepayment penalties. So if you're going in there and the client's just gonna do, paint and carpet and spend 10 grand, and they wanna sell the house in 6 weeks, that's perfect. There's no fee to do so. They're gonna make interest-only payments. On the rates, 10 to 13%, we actually, that came down a little bit. We're now lending down as low as 9. And again, interest-only payments during the loan, typically 2 to 3 points, 1 point obviously being 1% of the loan amount. And then other typical closing costs, appraisal and legal, and we do charge a commitment fee of $9.95. That's the only other fee we charge aside from points.
Can I ask a silly question?
Yeah, go ahead.
You say 10%. If we sell a property within the 6-month period, it's 10% for a year. Are you still gonna hold it to the 10%, or are you gonna prorate it down to the?
Exactly, it's prorated, yeah. So
Prorated?
you're only paying interest on the amount of time you have the loan. Which is kind of what I was getting at with, if you sell the house in 6 weeks, say you have a light cosmetic rehab, you're not paying a full year's worth of interest.
Right, let's make the math easy, let's say it was 12% rate, you're in and out of there 6 months, and you're really gonna be paying 6%.
Correct. I understand, I've heard some horror stories where they held them to that 1 year fee, the 1 year 10%.
That's a good point you bring up, because definitely not all hard money lenders are created equally. I can tell you, we've had a lot of success, not because we're the most aggressive or anything else, and we're among the most aggressive as far as our rates and our leverages, but it's because we really try to be open, honest, and transparent. When I get a borrower who submits an application and we want to do the deal, I get them a preliminary term sheet like right away. So there's no surprises, there's no last minute, this fee, that fee, the other fee. We try to keep everything up front and make sure that everybody's on the same page, because like you alluded to, the last thing you want to do is find out that your 2-month flip, now you're paying 1 year of interest on it. So,
What's your question?
Your draw schedule is set up 2-3 draws?
so this is probably
Depends
something we do that not a lot of other lenders do, which I think sets us apart a little bit. We're very, very flexible on draw schedule. So the draw, the construction portion of your loan, it's the same as any other construction loan. You take it in draws. So you do the work first. We come out and inspect just to make sure the work's done, and then we'll fund you for whatever you did. So rather than the typical way of, as you alluded to, 2 or 3 structured draws, you got to do whatever, demo, rough plumbing, rough electric, whatever, and then we come out and pay for it. No. Whenever you want to draw, let us know, we'll come out and inspect, and whatever work is done, we'll fund you for that amount. So let's say the guy's on a little bit of a tighter budget, he doesn't want to do $30,000 of work before he calls for a draw. He could do $5,000, $7,000, $10,000 worth of work. We'll go out there, and it's $150 to pay the inspector to come out, but you can do that as many times as you want, rinse and repeat until you're done with the project. So.
The borrower will be paying for the inspector to come out, or?
Correct, yeah, I think it's a $150 fee for the inspector to come out. He puts a report together for us, the lender, and that all happens pretty quick. So what do we usually say for a timeline? Let's say you want to get paid this week for some work you've done. I would say call us Monday for like a Wednesday inspection.
Right.
So if you think you're going to be done with electric or whatever on Wednesday, call us Monday. The guy will be there on Wednesday. He'll do his report Thursday, get it to us Thursday afternoon, and you'll get a wire for that amount, maybe Thursday afternoon or Friday morning. So we turn them around pretty quick. So this slide here, though, this is kind of relevant to you guys, because this is kind of what you would have to impress upon your clients who maybe are using cash right now. Listen, the fact is, if you're using hard money, there's financing costs associated with that. You're going to make less total dollars in the deal, but it's going to keep you nimble, it's going to keep you liquid, you're allowed yourself to do more deals that way. So, just running through the numbers here, your returns actually go way up using leverage. I mean, that's self-explanatory, but your net profit, $32,000 as opposed to $49,000. So yeah, you're not making as much money, but your total out-of-pocket cost is way, way less. So if you have investor clients who are doing 2 or 3 deals a year, this is a good way. And maybe they're still going to do some deals cash. But this is a good way for them to, expand the portfolio a little bit and expand the business and do more flips.
Do you do refinancing?
I'm sorry?
Do you do refinancing?
Yeah, that's a good point. So not only do we do financing for the purchase of the property, we'll actually do, if something you already own, we'll do a cash out refi on it so they can either go buy more properties or fix that property up itself. So we could do, cash out refi or for the acquisition.
But if if an investor has a loan on that property already, and then he wants to refinance in order to
Yeah.
move ahead.
Yeah, absolutely. So if you have financing on the property, the one thing is we have to be the first lien holder. So if you have a first mortgage on it, we couldn't go in the second position. But let's say you use the hard money loan to buy the property or something like that, or maybe you use private money to buy the property on like a 1-year note, and now you're ready to do some rehab. We could take out that first loan and give you a little bit extra money too on top of it, depending on what the loan amount is, and give you the money that way. Yeah.
I apologize, I might have missed it before I got here. What's the interest rate that you're charging?
Yeah, so the rates vary. It could be anywhere from typically 9 to 12%.
Okay,
And it's going to depend on really the investor's experience and also the location of the property. So, something that's, in a tough neighborhood for a newer borrower, they're going to be on the higher end of the spectrum. And, existing clients that are doing, flips in, great areas are obviously going to be on the lower end.
and then what is the credit requirement for the borrower? So let's say I'm doing a flip right now. What's my credit need to look like for you to lend to me?
So again, this is like asset-based lending, so really the deal itself is most important. As long as the deal makes sense, we try to find a way to make it work. So as far as credit goes, we'll go down as low as 600, maybe even 575 in certain cases. If the credit's down in that area, we'll probably want to use common sense, and we'll talk to the borrower and see what it is. Maybe it was a divorce or something else that, we think otherwise they're a responsible borrower, we'll probably do it, So we're a little bit more lax than a conventional lender on credit.
And also if you have not so great credit, and you got a partner that maybe does, well, we can always, use their credit, to do the deal.
And we do that a lot, so we'll have one person with good credit on the deal so that they qualify, and then maybe another person with a lot of experience to get the high leverage. So we can kind of just mix and match. Yeah. So this is just, obviously self-explanatory, just kind of going back to what I said earlier, how, doing more deals, making less money, but a higher return, in the end, you come out ahead, so. And these are just some examples of some flips that we've lent on. What's interesting is we have a lot of flips like this. This is in Bradley Beach, a beach town up in Monmouth County. Obviously, you can see it's a $763,000 house, but we lend on condos that cost $100,000. So it really runs the gamut. Two things I do want to mention. What was I going to say? Minimum loan amounts. So we try to keep the loan amounts at least $100,000. Now, if there's cases where maybe, let's say somebody wants to do a flip in Atlantic City and the price is much lower, we could probably do a loan amount $80,000 if we get an exception on it. But again, that's the total loan amount, so that's the leverage for the purchase and the renovation money. So usually that's not too hard of a bar to clear. And the second thing is, for newer investors, we typically don't do deals where the reno is more than the purchase price. We try to avoid situations where you're buying a $20,000 house and putting $100,000 into it. Just, over our history, we've seen those don't typically end well, or those tend to run into problems. So if you're a newer borrower, we want you at least paying, your reno should be less than what you're paying for the house.
So if the purchase price before the repair will be higher than the renovation,
Yeah.
so which means you are leading the investor to go for high-end purchase.
Not necessarily. Like for example, we do a lot of lending up in Essex County, like Newark, Irvington, East Orange. Those three towns are really popular lately for flips. So a lot of guys are buying stuff for $60,000, $70,000. So it's still a pretty low purchase price, and then they'll put $40,000 or $50,000 into it. Because that, as long as the rental budget is less than the purchase price, you're good to go. So it's still a lower purchase price, but we can make it work.
Based on experience anyway, what I'm looking at is this, based on what you just said now. Okay, I purchased a property, it was an auction property, but online auction.
Okay.
Okay. I purchased that property, it was in a very bad shape. And that property will cost about 100,000 to fix it, but I bought it about 20.
Right.
But I know that I'm coming out on it even. I'm coming out on it that pretty well.
Right,
because
yeah,
I
the
know-
repair value might be $250 or something.
Yeah,
right?
I know the receipt price will not be anything less than 195.
Right.
So what if I had come to you earlier and said, okay, I'm purchasing this property at 20, the renovation will be about 100,000, so you would have told me now.
Yeah, so there's two things I would say in that. One is that if you're an experienced borrower, we'll do it. We could do that. It's just if you're newer, we probably would avoid that. Or two, if you are a newer borrower, we treat anything within 90 days that you've purchased as a purchase. So I would say wait 91 days and we'll do it as a refi. So if you want to pay cash for it for 20 grand, and then wait 90 days, on the 91st day we can do a refinance and basically go off the as-is value, which I'm sure is much higher than what you paid for it. I don't know if that's the perfect answer for you, but that's kind of the two solutions to it. If we
So I wait 90 days, pay the tax and all that 90 days before you step in.
Yeah, so it's just a rule we have internally. Anything you're purchasing now or that you've purchased within the past 90 days, we treat it as a purchase. And like I said, we don't do a purchase where the rental's more than the purchase price. But on a refi, which would be 91 days or later, then we'll just go off the as-is value and then based on that.
Okay.
It's not really a seasoning period, but it's kind of seasoning in a sense, like a 3-month seasoning period where within those 3 months we'll treat it like a fresh purchase, that's how we underwrite it. And then after 3 months we treat it like we'll just as is value and lend based off that.
Based on that.
Yeah, and some of the logic is if you bought it for $20,000 and then like the next day I come in and lend off the as-is value, let's say it's worth 60, you have no money in the deal. And so we just try to avoid situations where you have no skin in the game. We definitely want the borrower to have some money down. So we figure if we make you wait, you know, that mitigates some of that risk for us. And again, it just goes back to the fact that just over our history, we've seen that those loans for newer borrowers tend to run into trouble. So we just do our best to not put the borrowers in that situation. But like I said, if you're experienced, we'll do it anyway, so it's fine. What else? As far as closing, let me just go over this real quick. So to get a loan closed, we move pretty quickly because we understand that investors, you know, a deal comes up, you got to move on it. What I usually have borrowers do is, Corey and I do this all the time, we'll have somebody submit an application, we'll run credit, if everything looks okay, we'll get them a proof of funds letter. And some guys email me 2-3 times a week for different proof of funds letters for different properties they're going to bid on. So I'll put the address in there, whatever amount they want, and they use that to go out there and make offers showing that they have access to the capital. And then from the time they get a deal under contract to the time we close, could be anywhere from like 2 to 3 weeks. So a lot of borrowers will try to get a contract for 30 days. That's plenty enough time for us to do what we need to do to get the deal closed. So we need basically title, we do an appraisal, we got to make sure the insurance is right for our standards, and some other paperwork, but that's the bulk of it, and we'll get it closed. And then most of that time, again, is appraisal takes what, a week to 10 days. We need a few days after that for our attorney to draw the closing documents, and then we're pretty much right at the 2-week mark, and we can get it done. You want to mention it's the rental product?
Well, yeah, to go off what you were saying earlier with the refinancing. So like, let's say you had a borrower that actually owned a rental. I mean, we can use it for a purchase as well. If you had,
This is a separate product. Aside from the hard money loans to purchase and fix up, if you don't need construction money, we have a rental product that's sort of similar.
right, it's a little, like you mentioned, there's a 12-month term for the hard money loan, or the rental product's a 2-year term with the 1-year extension. It's a little better interest rate, 8 to 9%, same thing with the points. But it's helpful if you have a client, maybe they own or if you own an investment property, you want to pull some cash out, you own it outright. This one's more credit driven, it starts at 660, and there's 3 different tiers, obviously over 700 you get the best leverage. I think the only really requirement is that you want to see that the rent payments are 125% of the interest payment, so what you're collecting in rent. That's for market anything?
No, so just to make it even more simple, like you have 2 products. We have the hard money loans to acquire and fix up properties, and then sometimes we'll put borrowers into the rental product, which again, both these are no-doc loans. We're not looking at debt-to-income ratios, or we don't need to, we don't care about salaries or anything like that, as long as the deals make sense. So a lot of times if they want to keep the property, we'll put them into the rental loan at an 8% or 9% interest rate. For a no-doc loan, considering a full doc investment loan could be 5.5%. It's not a bad alternative if, say, your client's a business owner or something that doesn't show any money on his taxes, so they can't get traditional financing. That could be a good option for them as well.
Yeah, it's not a bridge loan, but it can kind of be used as one, especially if you want to refinance out of a hard money loan, you can't get conventional yet, and this might be a good option to kind of bridge that gap into a longer term loan.
Is your rental based on single homes, or you can still do condominiums and all that apartment?
Yeah, so we could do a lot of different stuff. So the bulk of our business is single family fix and flips, but we love small multis, you know, the 2 to 4s. We can do condos, we can do mixed use buildings as long as the residential component is more than 50%. So we do a lot of stuff in like Elizabeth and places like that where maybe it's a store downstairs and 4 apartments upstairs, things like that. And we love multifamily. So you got a small multifamily building, you know, 5 up to 20 units, or even bigger for that matter. We can lend on all that stuff as well. I think, oh yeah, so this is a condo deal we did. So, you know, we did a high-end flip in the other slide you saw. You know, here's somebody, purchase price $130,000. So that's probably a little bit more realistic for what your clients are probably going out looking for. Just some more pictures. And that's all we really have for the slide, but questions?
Let's say I'm buying a house on an island and it requires flood insurance. Of course, if I'm buying cash, it doesn't require me to purchase,
Yeah.
get the flood insurance. Me using a hard money, would it require me to get the flood insurance?
It would. Yeah, so if it required flood insurance, we would make you have that to do the loan.
Do you do your own insurances? In other words, you go out and have someone write a policy for the property, whether it's a rehab or flood zone, whatever. Do you have that yourself, or do we go out and get that?
Yeah, you can go out and use your own insurance broker. I mean, I have insurance brokers who I work pretty closely with just because they're very familiar with our standards and our minimum insurance requirements. But you can use whoever you want. And we have a one-page thing, and it's basically our insurance requirements, which includes the flood stuff, if it's applicable in that
So
situation.
we'll be getting a copy of that to give to our insurance agent?
Exactly, yeah, I'll give that to you. We try to package everything up real neat and clean, so like, you know, we will help you get we'll order the appraisal, you know, we'll work with your title company, we'll help you get the insurance set up, and try to hold the borrower's hands right to the end, so make it a pretty simple process.
Is there any pre-qualification that a potential investor would come to you and kind of get pre-qualified or
Yeah,
anything
so
like
that's
that?
kind of what we were referencing before with the proof of funds letters. So if somebody comes and submits an application, even if they don't have a property yet that they have in mind, we'll run credit, we'll run a background check. If that looks okay, and we're comfortable with them as a borrower, we'll do proof of funds or pre-qual letters, whatever they want. Which actually is a great thing too, because then when they do find a property, we've already approved them. All we have to do is underwrite the deal itself, so we can move even quicker.
Oh, that expedited, okay.
As Anthony mentioned, it's very minimal, the documents reflect on the borrower.
I'm sorry, I couldn't hear.
I was gonna say, as Anthony mentioned earlier, it's very minimal on like what we collect from the borrower. It's really about the asset. So I think when the borrower, aside from running credit and background, we'll collect 2 years tax returns just to really see if they filed, and then 2 months bank statements to see where the funds are.
The reason I'm asking a lot of these questions is because I had an investor that I was telling Sean, did everything wrong, including getting the finance, and he went through a hard money lender, and he got hammered left and right. He lost money on the deal, but that was all his fault, and I'm just trying to understand it for myself, so I can,
Yeah.
again, redirect him.
And one thing I want to mention too is there's a few national companies that do hard money, and so we'll go down to 9% for like super experienced borrowers. Maybe they'll beat us by half a point, they'll go to 8.5 or something, but these guys are nightmares, and we get so many borrowers who have had bad experiences with some of the national companies who come back to us that'd rather pay the extra half-point interest, which is $40 a month or something, because the documentation and the process and all the hidden fees and everything else is just, it becomes very, very cumbersome, and you know, like you're a guy had a bad experience, so.
The hidden fees, exactly.
Yeah, like I said, you're paying for a title, appraisal, attorney. We charge a $9.95 processing fee and your points. But that's all going to be given to the borrower right up front. You apply, we like the deal, I'm going to send you a preliminary term sheet like immediately, because you're going to see what your rate and points are. There's no surprises, nothing hidden, and we've done very well just going out of our way to be super transparent. So I think that's paid dividends for us. But what else, Cor?
I mentioned too, I mean, the partners that, you know, own the company, they've been doing their own flips for 10, 15 years. You know, so they're coming from a place of experience when they're looking at the underwriting deals and everything.
And we do that all the time. So our company will do some of these high-end flips some things like this in the local shore towns up in Monmouth County. It's a separate business, but the point is the managing partners, like Corey said, have the experience, and so if your borrower is running into a snag or there's an issue with draws or something like that, we kind of have the know-how and the experience to really help people through it, so there's a little bit of added value there. And we love doing these types of presentations because we have a lot of realtor partners who, this is a big part of their business. It's great for you guys in the sense that you could potentially, you get it twice, you may be selling the property and then you sell it when it's done. And nobody does one successful flip that I know of. If you have a good experience and you make money on your first flip, you're doing number 2 and 3 and probably pretty quickly. So you're talking about potentially 6 deals for one realtor if the guy does 3 flips a year and you get both ends of it. So it could be a powerful part of your business. And it's almost like we're a team with a lot of realtors. It's like they find the property, they have the financing, and they go to the bar and say, look, here's or the client say, here's everything. Here's your deal, here's your financing, and let's get it closed. So it could be a powerful thing. If you want to make this a part of your business, we would love to work with you guys and hopefully, have a nice, long, fruitful relationship.
Anything with commercial properties?
Yeah, we love commercial deals too. Our favorite really in the commercial space is the bigger multifamily stuff, but we do have outlets for retail, office, certain industrial properties. And a lot of times with the commercial, it's really just a function of the borrower wants to use hard money just to acquire the property. He found a great deal, let's get it, and then afterwards you can almost worry about refinancing into a more traditional commercial loan.
Can you do those as well?
Sometimes we'll do them, sometimes we have partners we work with for the commercial stuff. To be candid, our bread and butter is the single family fixed flip and anything multifamily. But we can certainly help get your borrower funded for commercial stuff as well.
And you require the title be taken in an LLC?
Yeah, so we mentioned that a little bit earlier. So under 99% of cases, we want it in an LLC because this is a commercial loan.
Personal
and
guarantee?
Yeah, everything's personally guaranteed. If you look at it, if you open a brand new LLC and it's not personally guaranteed, there's nothing there, So yeah, it is personally guaranteed. And it would have to be in an LLC. Like we had a case, I had a borrower where I think he was bidding on a property that Fannie Mae had taken back or something like that, and you can't change who's on the contract, and he had put his name down. And so I went to underwriting and got an exception that we let him close in his personal name, but we just made him sign a document saying that this is not going to be his personal residence, this is an investment loan, this is a fix and flip, and he was okay with that and we were okay with it. So we want it in an LLC, but if something like that comes up, we can sometimes be flexible and work with the borrowers.
Or even had a rental property that was already in their own name, obviously not going to require them to put an LLC before we lent to them.
Right.
If you had to refinance, that might be a little bit more common too, yeah.
Okay.